Assalamualaikum. Welcome to lecture 14 of ATX. This is the continuation of lecture 13. In lecture 13, I have introduced you to inheritance tax. So there we went through the basic rules, how to calculate inheritance tax on lifetime gifts, and when the donor dies, the impact on IST and the death state. Here, so we stopped in the last lecture with the death state. Here we are going to go in depth how to calculate the death state, what are the rules, reliefs, and special valuation relating to the death state. Lifetime gifts and impact of lifetime gifts when the donor dies has been covered in previous lecture. This lecture will be covering death state. Now, so if you haven't watched IST in previous lecture, please go back and watch it under my ATX playlist because that will help you to understand inheritance tax better because the basics I've explained you there. The due date, the rates of IHT, the starting point, calculation, everything. So here I'm not going to repeat it. Okay, I'm assuming you have the basic knowledge and I'm going with the advanced level. Now, here we are going to focus on special valuation rules for lifetime gifts. Some gifts have some special rules. In lecture 13, I have covered the basics. Like for all lifetime gift, what is how to calculate IHT. Here, for some gifts which are made during lifetime, or even in the death state has some special valuation rules. We'll go through them. Then, so now like any other tax, how we have reliefs in income tax, CGT, we have for IHT also reliefs. Some reliefs are for lifetime, some are for death. Then business property relief. This is new in ATX, was not there in tax. Agricultural property relief, again new in ATX, not there in tax. Death state computation, very important. And special valuation rules affecting the death state. This is new. Reduce rate of IST for substantial legacies to charity. Briefly, I came across this in the previous lecture where I told you that usually death rate for IST is 40%, but it can reduce to 36% if you are leaving your property. Okay, the legacy is left to charity, and there is a amount for it. There is a threshold for it. We'll see it. Then reliefs against IST on death state. Quick succession relief. This is another relief and summary. Okay, we also have double taxation relief, but double taxation relief has been covered in CGT and income tax. Now, so starting with lifetime gifts. Okay, we are going to go through. This is an overview of the lecture. Special valuation rules, reliefs. Under reliefs, we have BPR and APR. Death state, we have special valuation rules, charitable legacy. That means when IST is reduced to 36% and quick succession relief. Quick succession relief is only on death state computation. It is not applicable for lifetime gifts. Now, so this lecture covers further considerations which can affect the calculation of IST on lifetime gifts on certain assets, reliefs, detailed death state computation. Detailed death state computation was not done before. In tax, you study the basic IST calculations, but the reliefs and the special valuation rules, whatever the reliefs and the special valuation rules I'm going to cover was covered in tax. They fit into the basic calculations. You need to be prepared to explain when they are applicable and why, rather than just being able to deal with the figures. See, in ATX, it's not just about the number crunching. You should be able to explain why, when they are applicable, in what situation and why they are applicable. So you have to know the theory part of it. Now, so as stated in the previous lecture, the transfer of value, I'm sorry, the previous lecture is 13, not 14. This is the 14th lecture. Okay. As stated in the previous lecture, the transfer of value. So we start IST with transfer of value. It is normally what? The open market value, OMV, of the asset gifted. This we all know. But some assets have some special valuation rules. First type of asset, quoted shares and securities. So for quoted shares and securities, this is how you do. You have, when it's quoted, see, for unquoted shares and securities, we have another rule. For quoted shares and securities, we have another set of rule. So do not confuse the two. When it is shares and securities, you have to see, when you're gifting shares or security, you have to see whether it's quoted or unquoted. If it's quoted, this is how you value. Okay, and you have to remember this valuation rules. Okay, lower off, quarter up method. Quarter up method means using the range of prices quoted on the stock exchange on that day. They will give you the price, and so this is how you find out. They will give you two prices. Okay, take the lower of it, lower price plus 1/4 into higher price minus lower price. This rule is fixed. Second, average of the highest and the lowest price. Whichever, the quarter up method or average method, whichever is the lower is the value of the quoted shares and securities. That is the open market value for quoted shares and securities. You, because it's quoted, they will give you the price. Note that these rules are not the same as the valuation rules for CGT. If you have followed all my lectures, you know, in CGT, capital gain tax also, we came across this valuation rules for shares and securities, quoted shares and securities, but there the rule is different. Here the rule is different. Twice you have to learn. One is for CGT, one is for IHT. Next thing you have to remember is cum and X. Cum dividend, cum interest, X dividend, X interest. X and cum, these two words you have to remember. Why? Because the prices are usually quoted as cum dividend, or if it's shares, cum dividend. If it's securities, cum interest. Securities means all types of loans and all. And for loans we have interest, and for dividends we have, for shares we have dividends. That's why this one. So in exam, always assume shares and securities are quoted cum. If it's dividend, it's cum. If it's interest also, it's cum. Always it is quoted cum unless the question tells you otherwise. If the question remains silent, they don't say whether it's cum or X, you have to assume it's cum. Okay, now next, X interest or X dividend. This is how it is calculated. See, if it's X, you take value using the lower of rule. Of course, because they are quoted, you'll be taking the lower rule, lower of markup, quarter up and average. Add the next dividend with it. So in the cum we don't add the dividend, in the X we add the dividend. That is the difference. X next dividend payment for dividend, and if it's security, next interest payment. Amount received less 20% tax. Capital value to include in the state. You see. Now, cum dividend. What does it mean? If the shares are sold, they are sold with the right to the next dividend payment. The shareholder buying the shares will therefore receive the next dividend payment. Similarly, if securities are quoted cum interest, person buying the security will receive the next interest payment. X dividend means without the right to the next dividend payment, and if it's security, without the right to the next interest payment. Okay. So this is what you have to, this one. Similarly, if securities are quoted X interest, owners of the securities on the date they win X interest will receive the next interest payment. Don't worry if you have not understood anything. We'll do questions to clarify the difference between X and cum. Now, let's say if an individual dies when shares and securities are quoted X dividend or X interest, individual will be entitled to the next dividend or interest, which in practice, see, in practice you will receive it few weeks later, but you'll be entitled to that. So accrued interest to which the deceased was entitled is included in the death state. That accrued interest will be included in your death state. Net of basic rate 20%. Why? See, executors will account for the income tax at the basic rate. What is the basic rate of income tax? Don't forget income tax when you come to inheritance tax. It is 20% to HMRC. That's why. Now, so this valuation rules apply to all the quoted shares and securities, including these few, they are quoted. Whether it's investment trust, open-ended investment company, gilt security, venture capital trust, real estate investment trust. So, before we move on to the next type of gift, we finished with the quoted shares and securities. Next, we'll be moving to unquoted. Before we move on, let us do a question on quoted shares and securities valuation. Test your understanding 1. So, in test your understanding 1, calculate the value to include in Jeremy's state in respect of loan notes. Okay. Owned 100,000, 10% loan notes in XY PLC. Okay. 100 of the loan note were quoted at this date. So you can see you have been given the high and the low price and it's a quoted security. Always you have to find out what type of uh, gift it is. That then only you can value, because in the exam you will be given mixture of it, quoted, unquoted, and others. They are quoted X interest. See, they told you X interest, so you don't have to assume it's come. Interest is paid on the loan notes every 6 months on 30th June and 31st December. Okay. First, lower of, because it's quoted security, lower of what? Quarter up and average method. So quarter up. What is the method to find quarter up? Low price. Low price is what? The price is 94.98. 94 is the lower price plus high price is 98 minus low price is 94 into 1/4. Remember, do the multiplication first. Bottom-us. Okay. So it is 95. 95 is the price. Now, what about average? If you do average of 94 plus 98 divide by 2, just do and see, 96. Which is lower? This one. Quarter up is the lower. So 95 is the price. Okay. It is 95 per 100. Okay. 95 per 100. So value of 100,000. What is the total amount? 100,000. 100 of the loans. Okay. 95 per 100. So it's 95 per 100. So it's 95 divided by 100 into 100,000. Okay. Is the price, which is 95,000. With this, it's X. You have to add. With X, you should always add the next interest payment. And if it's come, you don't have to add. For 6 months, 100,000 into, you see, loan notes every 6 months. What is the interest rate? It's 10%. And one more thing. Often you will mix this. This is net of tax. Net of tax means after deducting tax. What is the tax rate? 20%. After tax, it will be 80%. So do not forget this 80%. Most of you will forget this 80%, which is 4,000. So 4,000 you add with 95,000, it adds up to 99,000. This is the value you have to include in the state. This is the capital value of the loan. After quoted shares and securities. Next, Valuation rule is for unquoted shares and securities. If it's unquoted, okay, then in your exam, good thing is you will be given the rate. So in the examination question, the value will be given to you. And for a lifetime gift, diminution in value calculation will be required. That means transfer of value. Next is unit trust. So unquoted share is very easy. Whatever the value is given, you take it. Unlike quoted, quoted you have to do the valuation. Quarter up and average, lower of the two. Unit trust is the third type. Okay. Third valuation rule is for unit trust. If it's a unit trust, remember they are valued at the lowest bid price. So do not use the 1/4 up rule. Now let us do a question on unit trust valuation. So test your understanding to calculate the value of the unit trust for IHT. She owns 5,000 units and the quoted prices are 125 pence to 133 pence. Remember the lower, so it's 125 pence. Means 5,000 into 1.25 pounds. So it is 6 to 50 pounds. This is the price. It's very simple because the lower. So we finished with quoted shares and securities, unquoted shares and securities, unit trust. Now we are moving on to related property. The fourth valuation rules, related property. Related property is a question which is very likely to come in your ATX exam because this has a variety of areas for you to test. So for your in your ATX exam, more than the unit trust, unquoted or quoted, this related property part is most likely to appear in your ATX exam. So make sure that you know this very well. And this has more work compared to quoted, unquoted, and unit. They are easy. Related part is little bit, I would not say it's very difficult, but yes, it has a lot of things for you to remember if you want to get the calculation right. So property is related to the donor's property if it is a property of a similar kind owned by donor's spouse, an exempt body, as a result of the gift from that person or that person's spouse. What is an exempt body? Any charity, qualifying political party, national body, or housing association. If any of these four are mentioned in your exam, they are exempt body. So property held by the exempt body is deemed to be related for as long as the body owns the asset and for 5 years after they have disposed of it. See, why related? When a property is related, they are brought together. They're dealt together. Sometimes it's a relate. So let's say you have a property, your spouse has a property, and both are related. Okay, or you are giving a property to an exam body and it's related to you, and that exam body has that property, that means owns the assets, and for 5 years after they have disposed of it. Then it is deemed to be related. We'll definitely do questions on this. So in the exam, the most common related property is what? Property owned by spouse, donor's spouse. Note, the property of a similar kind owned by the donor's children are not related property, remember, or any other family member. Only it has to be spouse or exempt body. If it is not the donor's spouse, let's say the similar kind of property is owned by the donor's children or the donor's other family member like mother, father, they are not related property. So there are special valuation rules for related property, and it applies like this. Unquoted shares. So the related property could be your unquoted shares, could be the collection of antiques and chattels, adjacent plots of land, any of this. Okay. Now, in exam, related property rules normally apply to unquoted shares. Unquoted shares. This is how. So this calculation you have to remember. This is the area I'm talking about, which has a very high chance of occurring in your ATX. That is A divided by A plus B into, we'll see what this A and B are. Value of the total combined assets of a similar kind. So when they are related, add them together. If they are similar kind only, you can combine them. If they are not similar, you can't combine, they are not related. So meaning of A and B in the formula is slightly different depending on whether the asset is shares or assets other than shares. It could be just shares or it could be assets. Let's say if it is assets, your A will be the value of the donor's asset. If it is shares, your A will be number of shares held by the donor. In both the cases, it is the donor's property only, whether it is asset or share. And B would be value of the related party's asset, and if it's share, number of the shares held by the related parties. It's very easy. Just change the asset with the share. You have to see whether share or asset. So A is the donor's part, B is the related party's part. Okay. Now, the need for the special related property rules. Before we do question on related property, let us see why do we need these rules. There are some reasons why we do it. So this prevents a married couple from deliberately splitting the ownership of the similar asset to avoid IHT. Yes, what do? Married couple, when they have a similar asset, they split the ownership. They try to prove it that this is a different asset and the donor spouse is having a different asset. Why? Because they want to avoid IHT. So these are the following scenarios. We'll see. Now you will understand better how they avoid IHT and how the tax officer catch them so that they pay IHT. First scenario. See, these are just examples. You don't have to remember these examples. This is just for understanding purpose. 1st of July 2023, let's say Joe owns 60% of share capital of XYZ, which is an unquoted company. The shareholding was valued as 600,000. Okay. If Joe dies, he will be charged to IST on 600,000 because that is the value. Okay. Now, on 2nd July, Joe is giving 30% of the shareholding to his partner, civil partner. So this transfer being to civil partner is exempt from IHT. This transfer that is doing to a civil partner, see whether it is civil partner or spouse, they are exempt from IHT. From 60 is giving 30% to the spouse or civil partner, exempt from IHT. Why? Inter-spouse transfer exempt. You have to know these rules why it is exempt. So now only 30% shareholding is there because the from 60-30 is given, that 30 is exempt, only 30 IST will be paid on that 30%. And they have already given you the valuation. They will give you the valuation. Don't worry. You don't have to worry about it. So that 30% shareholding is valued at 200,000. So if this special rule was not there, what happens? Let's say Joy and his civil partner, both, okay, were to die on that day only. Then they will be charged to IST. How much? 2 into 200,000. Why 2 into 200,000? Now there are 230%. Understand the scenario. First, XYZ was having 60% alone. He paid the entire IST on 600,000. Now, 30,000 is worth 200,000. So Joy is having 30,000. He is paying on 200,000. The civil partner is having 30%, which is also valued 200,000. He is also paying 200,000. So that's why into 2. That's why 200,000 into 2. So they are paying IST 400,000. If they both are to die, IST will be 400,000. Both have to pay IST. It becomes chargeable. Now, so if you see, before how much they were paying and now how much they are paying. The 230% shareholding, if you see the 230% shareholding are worth less than the 60% shareholding. You see the two shareholding are 400, but 160% was 600,000. Why was it less? Because that 60% holding gives control. But 30% does not give you a control. Even if both of them are having 30%, none of them are having control. It is only giving them a minority interest. That's why that worth is less. Now, third, assume on 3rd July, third day, both joint and civil partner died. Without the related property rule, IST is 400,000. Each will be paying on that 200,000. Joy is paying on 200,000, civil partner is paying on 200,000 because they both have 30% shareholding each. But if Joy had not made this interspouse transfer, that means Joy alone has 60%. So that 60% interest was valued as 600,000. Okay. Therefore, without the special valuation rule, by splitting the interest between the couple, how did they split the interest between the couple? 30-30%. 200,000 of value goods came AST. You see, earlier they were paying 60,000. Now also the interest is 60% only. But Joy is having 30%, civil partner is having 30%. So both of them together are paying 400,000. Whereas they should have paid 600,000 because 60% interest was valued at 600,000. So 600 minus 400. How much are they escaping from IST? 200,000. They are paying 200,000 less of IST. You see, they are escaping that IST because they have split the interest among themselves 30-30 by transferring to the spouse. So without the special valuation rules, they are paying less IST. They are escaping the IST rule. That's why the special valuation rules are done. Since the related property valuation will always give a higher valuation because you will add the two property. Then, okay, that ignoring any related property value. So this will always be the default assumption at ATX unless specific direction is given to the counter. Okay, if it's related property, you should always add. Now let us summarize special valuation rules. With this, we have finished the special valuation rule for all the four types. We started with quoted shares and securities, unquoted shares and securities, unit trust, and related property. For quoted, lower of, quarter up, and high average of high and low. Unquoted, diminishing value concept. That is the transfer of value. Unit trust, lowest bid price, related property. If the property is of a similar kind that is owned by the donor spouse, this is the value you have to use. A divided by A plus B. A is the value of the donor's asset. B is the value of the related property into value of the combined asset. A and B are the value of assets, or A and B could be the number of shares. Now let us do question on related property valuation. Test your understanding 3. So in test your understanding 3, calculate the transfer of value relating to the gift of one share for IHT purpose. Now, Sarah owns 2 shares which are part of a set of 6. You see they are related. 2 from 6. Her husband owns another 3 and her daughter owns 1. Sarah gives 1 share to her son. Value of each share's value is given. Okay. Remember, you have to find the diminution value. Diminution means before the gift and after the gift, the value of the share. Okay. So before the gift, see, this is a related property. Okay. Whatever the daughter has is not a related property. It does not come. So Sarah owns 2. Husband owns 3. Total 6 and daughter owns 1. That's why total 6. But for related property, only the Sarah and the husbands will be counted. 2 chairs and 3 chairs. Daughters will be ignored. 2 plus 3 is 5. 5 chairs. Related chairs are 5. After the gift, they have given 1 chair to son. Okay. So they have given 1 chair from 5 means now they will be having 4 chair. 1 is gone, 4. Okay. So now using this, we'll do that calculation A plus B. A is for the donor, B is related. So who is the donor here? Donor is Sarah. How many chairs Sarah is having? 2 chairs. So what is the value of 2 chairs? 15,000. This is A. First identify that. Then B. B is related property. That is husband. Husband is having how much? 3 chairs. 3 is worth 25,000. And what is the total chair before gift? 5. So what is the value of the 5 chair? 60,000. This is the number that you have to multiply with. So first we'll do the before gift. The value of the Sarah's chair before the gift. So we have got the value of A and A. So A is 15,000. Sarah has 2 chairs. Then 15,000 A. B is 25,000 because with the husbands. Into 60,000 because total chair is 5,000. 5 chairs before the gift. So it is 22,500. Now, after the gift, what is the value of the chair? He's giving one. One chair is given away. So from 2 chairs of Sarah, Sarah will be having now 1 chair. 1 chair's value is 5,000. But husband will remain 3 chairs only, 25,000. And now there are 4 chairs. After gift, there will be 4 chairs, so 40,000. So now Sarah will be having 1 chair. Value is 5,000. That means A is 5,000. Again 5,000. Husband will be having 25,000 only, and this will be now 40,000 because total 4 chairs, which is 6667. So it is 15,833. This is the transfer of value. You see, this is now. This is just for a note purpose. Okay, I finished the IST. For IST, this is the value, but for CGT, this is just for understanding your CGT also. Okay, what would be the market value of the asset gifted? See, for CGT purpose, we use the market value of asset gifted. Okay, what is the market value of 1 chair? We gifted 1 chair, no? So market value of 1 chair is 5,000 only. This would be for CGT purpose, it would be 5,000. Okay, and if you see 1 chair is worth 5,000, we have gifted 1 chair, right? But if you see this value 15,833 is higher than 5,000. This is what related property valuation does. It's always higher than unrelated value. Unrelated value of 1 chair is just 5,000. Because we have used the related valuation special valuation rules, it's higher now. That means you can't skip IST. But in CGT, you will use 5,000. Now, next question. Illustration 1. Here you have been given ordinary share in Monsoon Limited, an unquoted trading company. Issue share capital 100 of 1 each. The percentage of shares before the gift. So the percentages, okay? Frederick, then his wife, his son, his daughter. Gives 5% of his shares to his daughter. Value of the share on the date of the gift. Okay? Now, calculate the value of the gift for IST purpose before exemptions and reliefs. Now, to do this, that is a working that is required. You need to know the percentage before the gift and after the gift, and only of 2%. Marja and Frederick, because only they are related. We don't care about the son and the daughter. So Frederick and this one, if you add 40 and 35, it is 75%. He has given 5%. So that means after gift, it is 70%. How? From Frederick 5% will reduce. After gift, 35%. But Maja will be having 35. Why will be having 35 only? 35, 35, 70. Before 75, after gift, 70%. So 75% holding is 105,000. 70% value is 80,000. Okay, value is given. So we have to find the value of Frederick shares before and after. See, this 70 and 70% when you're taking it is the combined, but we want to find the Frederick's value of Frederick share before and value of Frederick share after. A and A plus B. So what is the way? A donor is Frederick. So A, before he was having, before Frederick was having 40% out of 75 into what is the value? 105,000. 56,000. After giving 5%, Frederick is having 35. A, 35 plus 35, so 70% into 80,000. 40,000. So 16,000. 16,000 is the transfer of value. Done. You see, this is very easy. The transfer of value is very easy once you understood. Now test understanding 4. Here also we have similar question, just the name is changed. JM has wife, brother, father, sister, father. Only wife and the JM are related. Okay, so JM gave his son 6,000 ordinary share. Unquoted. Everything is unquoted. Now, 20,000 share, they have given the breakdown. And they have given the agreed value also of the holdings. So same question. Okay, it's the same question. So now you have to know the percentage holding. If you don't know the percentage holding, you can't find the value. These are given in terms of numbers. Okay, Jim and his wife has 8,000 and 2,000. That means total 10,000. So out of 20, total how much? Together they are having 10,000, which is 50%. Holding is 50%. After the gift, they are giving 6,000. So 6,000 will reduce from James. James will be having then 2,000. He'll be having 2,000. It's 4,000. So 4,000 out of 20,000. It's 20%. Before gift 50, after gift 20%. So at 50% holding, value is what? 7. And at 20% holding, it is from this range, it's 4. So 7 and 4 are the price. You see, we'll find the value, total value. How much James has? 8,000 at 7. And then 6,000 sold, 2,000 at 4. So 56 and 8,000 deduct 48,000. This is the transfer of value. We used this just to find the value. We already used the related property A and B for this one to find the percentage, and then we've got the value. Multiply that value with the James number before and after gift and got the transfer of value. Done. Next, from the valuation rules, we are moving on to the reliefs for lifetime and death transfer. Two key reliefs are there. This is available for both lifetime and transfers on death. They are BPR and APR. BPR. So the relief, this relief is given automatically if conditions are satisfied. You don't have to make any claim. This relief reduces your transfer of value by either 50 or 100% depending on the type of business property being transferred. We'll see in the table in the next slide which ones are 50 and which are 100%. This applies to your worldwide relevant business property, not just UK. Applies to both lifetime transfer and death state valuation. And on lifetime gifts, this is deducted from your transfer of value before any other exemptions or reliefs. So now, the conditions to be satisfied. Number one, property has to be a relevant business property. It has to be held for the minimum period of ownership. We'll see what are this relevant business property, what is the minimum period of ownership later. Relevant business property. So for this type of, these are the relevant business property, and for this properties, the rates are given. This table will help you in your revision. First type of property is unincorporated business. Any unincorporated business is a business property. Okay, a whole sole trade business or partnership interest. When you're gifting, it's a relevant business property, and for that you are going to get a 100% relief. If you are gifting your entire sole trader business or your partnership, the relief is 100%. Next, unquoted shares and securities. Unquoted shares means any AMI listed shares and securities. Relief on share is available regardless on the number of shares held. See, the moment you have share, any number of share you have, relief will be given. Relief is also available for securities, but in an unquoted company. But only if the individual has a voting control of the company immediately before the transfer based on share ownership. Okay, you should have a control immediately before transferring your share ownership in the unquoted company. Then only you will get the relief for the securities. Relief is 100%. So two types of property has 100% relief: sole trader business, unquoted shares and securities. With these three things are there. Next, if it's quoted shares and security, relief is 50%. Quoted. And this relief is only available if the individual has a voting control. Control means more than 50% of the company immediately before the transfer. That means before you are transferring your shares and securities, quota shares and securities, you should have a control more than 50%. Then only this relief will be available. If you're having, let's say, 30% of quota shares and securities in your selling, you are gifting, you will not get any relief because you don't have control. To have control, you should have more than 50%. Next, land and buildings, even this is 50%. Land, buildings, plant or machinery used in a business, not for your personal reasons. It could be land, it could be buildings, it could be plant or machinery. This relief is only available if carried on by a company in which the donor has control or a partnership in which the donor is a partner. Remember, if it's a company, donor should have the control. If it's a partnership, donor should be a partner. And then if you're using any land business, for that, relief is 50%. So there are 4 types of relevant business property given to you. First two, unquoted shares and security, sole trader business, 100% relief. Quoted shares and securities, land, buildings, plant, 50% relief. Now, next, you should note certain things about property, business property. Number 1, to say that you are gifting your unincorporated business, it should be a trading business. It can't be an investment business. That unincorporated business should be a trading business. And if it's a company, then the individual should have shares in a trading companies. That's why I've highlighted trading business, trading companies. Then, if you want to see whether you're having control, remember that related property holdings. Just now we have studied, we have finished it. That related property holding must be considered. That means you and your spouses. Next, PPR is not available if the asset concern is subject to a binding contract for sale at the date of transfer. If you have a contract for that asset to be sold, you have a contract already in place that you're going to sell this asset, BPR is not available. The most common example of where this happens is where a partnership agreement provides for the interest of the partner to be sold to another partner in the event of death. Let's say a partner dies. So his shares will be sold to the partner who are alive. Because this is a binding contract, no BPR will be available. However, if the agreement provides an option for the other partners to purchase the interest, see it's an option, then it's not a binding obligation that you have to purchase the person who died, right? You don't have to purchase their shares, not binding, then BPR will be available. Now let us do question. Test your understanding 5. We have 5 assets and you have to state whether they qualify as business property or not. And if they are relevant business property, state the amount of BPR that will be given, whether 100 or 50%. First one, 45% of the ordinary share capital, a quoted trading company. Tell me, BPR is available? No. No BPR. Why? He has 45%. That means no controlling interest. And also ABPLC is a quoted company. So no BPR. Next, 15% of ordinary share capital of DF Limited, an unquoted trading company. Is it available? Yes, BPR is available. At what rate? 100%. How? This is an unquoted trading company. Okay. Next, third, factory owned personally by Judeline but used in partnership with Judeline is not a partner. That's why no BPR, because he was not a partner. Fourth, 35% in GIH PLC, quoted trading company. Husband also owns 12%. Daughter owns further 6%. Remember, for related, you can only take husband. So 35 plus 12 will not give him 50%. No control. And this is a quoted company. Even after taking the husband share, no control is there, no BPR. Last, 25% share in Green Limited and AMI listed trading company. Yes, BPR is available. 100%. Because it's an AMI listed trading company. Minimum period of ownership. Minimum period of ownership is 2 years. Immediately before you transfer, you should hold the relevant business property for at least 2 years. Then only you will qualify this for business property relief. If the asset was inherited on death of a spouse, then you take the couple's combined ownership period, whether it's 2 years or not. Now let us do a question. So illustration 2. State whether BPR is available on unincorporated business on Peter's death. Peter inherited an unincorporated business from his wife on 1st Jan. Peter died on 30th June 2023. Peter's wife had owned the property for 1 year. Okay, so if you check from 1st of Jan 2022 till 30th June, just calculate and see whether it's 2 years or not. With this 1 year you can add. So if you add 1 year, although Peter had owned the property for only 18 months, Peter, 1 whole year and 6 months, from 1st of Jan 22 to 31st December 22, 1 year and 6 months because till 30th June. So 1 year 6 months is 18 months. Okay, 18 months is not 24. But Peter's wife had owned the property for 1 year, so that 1 year you can add. It becomes 28 months. So it's more than 2 years. That's why BPR will be available. So total combined is exceeding 2 years. But there are there are exceptions to this 2 year qualifying rule. There are two key situations where the 2 year qualifying rule, even if it is not satisfied, BPR is still available. First situation, replacement property. Here BPR is still available if the business property was not held for 2 years. Why? Because it was replaced by another business property previously held. So where it is replaced and the individual owned some type of relevant business property for a combined period of ownership for at least 2 out of the last 5 years, BPR is available. So BPR will be given on the lower of the two property values. Remember, it cannot exceed the BPR that would have been given on the original property. Now, next situation is successive transfer. Here also BPR is available when the relevant business property held was eligible for BPR at the time it was acquired, and it was acquired either as a result of death or now is chargeable as a result of death. BPR is available. Let us do question. Test your understanding 6. Calculate the gross chargeable amount of Marsha's lifetime gift to his sister. So, 31st December 2022, unquoted trading company JKL was taken over by MNO, another unquoted trading company. Marsha owned ordinary share for 4 years before takeover. Consideration of takeover consisted of ordinary share in MNO. On 30th June 2023, that is after 6 months, Marsha gifted her shares in MNO to her sister. Shares were worth 160,000. No lifetime gifts was made. Her shares in JK has been worth 110 on 31st December 2022. So tell me, how much? Before you do any calculation, gross chargeable amount. See, gross chargeable amount means what? They're simply telling you have to find transfer of value, deduct exemption. You have to deduct BPR again before you deduct any other exemption. We have annual exemption. 3,000 of the current year and 3,000 brought forward. If exemption is there, then it could be BPR. This relief could be there or could not be there. We'll see the condition. Transfer of value is simply 160,000. So we'll see whether this is available or not. Okay. If this is available, we have to see then the answer is known as gross chargeable amount. That means that will be taxed to what? IST. So now, for this we have to see the duration and everything, and whether we have to see whether it's relevant property or not. If you see shares in MNO are held for how many months? 6 months only. Because this JKL was taken by MNO on this date, 31st December 2022. And on this date, 6 months after you are gifting it. So only 6 months you are holding MNO. But still, BPR will be available at 100%. How? Because what Marsha has held is a relevant business property. MNLO limited shares and JKL limited shares. And it's more than 2 years out of the last 5 years. You see, he's holding it for 4 years before the takeover. So that 2 out of 5 is satisfied. More than 2 years is holding it. So the amount of BPR will be restricted to what amount? See, the shares in JK was 110. The share in MN is 160. The amount that has been, the share that has been replaced. But they told that BPR that would have been given on the original property. Okay, so BPR given on the original property cannot exit. Whatever you are giving on the original property cannot exit the amount when we are replacing it. See, if you see the replacement amount is greater than the original amount, BPR would have been given on this amount. So you have to give BPR up to 110,000, not 160. So BPR is restricted to 110,000. As BPR that have been given on the original property, that was replaced. It cannot exit. So because 110 is BPR, gross chargeable will be 44,000. You see, you have to write these conditions in the exam and then do the calculation part. Next, under business property relief, we have what is known as accepted assets. So to qualify, the uncorporated business has to be a trading business, or individual must have shares in a trading companies. There is no relief for interest in investment business. This we all know. However, an individual may own an interest in trading business, but that business owns some investment assets known as accepted assets. When this is the case, BPR is available, but it will be restricted. Amount will be restricted. Investment activities. So these are the investment activities that prevent BPR from being available. Dealing in securities, stocks and shares, dealing in land and buildings, making or holding investments, which includes holding of land and buildings that are let. If you are having any investments in this, BPR are not available. What is the definition of accepted assets? An accepted asset is an asset that has not been used wholly or mainly for trading purpose throughout the 2 years, and it is not likely to be required for future use in business. Main example: large cash balances in excess of reasonable business requirements, investment in shares and securities, investment in land and buildings which are let. These are accepted assets. Now, restriction of BPR. So when we are transferring an unincorporated business, BPR is available only on the business asset. No relief for accepted assets. When we are transferring the shares in a company that has accepted assets, again BPR is only available on the business asset proportion of out of the total asset. This is how you calculate. So transfer of value into value of total assets less value of accepted asset divided by value of total assets. Now let us do question. Test your understanding 7. Okay, calculate the gross chargeable amount of lifetime gift once again. On 31st May 2023, gifted 40,000 shares and unquoted trading to her niece on occasion of her marriage. Has owned shares since 2008, and on 31st this day shares were worth 180. On that date, they own assets worth 500, investment properties 50 out of no lifetime transfer. Remember, it's a gift to her niece. It's a pet. Transfer of value would be what? 180,000. Transfer of value 180,000. What do you deduct? First, if there is any BPR, you deduct BPR. Then you deduct, this is occasion is marriage. So its marriage allowance is there. Up to 1,000 to any party. It's a niece. Then annual exemption amount. Current year and the previous year. Current tax year, previous tax year brought forward. 3,000, 3,000. Okay, remember BPR will be restricted because we have investment assets. Now, so first BPR is available. Okay, it's an unquoted trading company, owned more than 2 years. You see, since 2008 she is owning the shares. Unquoted trading company, so 100% BPR is available, but because he has an investment property, out of 550 is investment, so only on 450,000. So BPR would have been 100% of 180, but now it's restricted. 180 into 450,000. 50,000 will be deducted out of 500,000 because 50,000 is investment. So 162,000 is BPR. BPR has to be deducted before marriage allowance and annual exemption. So gross chargeable amount is 11,000. Withdrawal of BPR on death. When we are dying, BPR could be withdrawn. If conditions are not satisfied at the date of death, BPR is withdrawn. When you are calculating IST payable on lifetime gifts due to the death of donor. For lifetime gifts, the conditions for BPR are considered at the time of gift, and BPR is given at the appropriate rate when calculating the chargeable amount of CLT or PET. This we know. If the gift becomes chargeable on death, BPR is again considered at the time of death. It's not that once only you see the condition and you give BPR forever, ever. It's not like that. Again at the time of death, if the gift becomes chargeable, you see BPR is available. Because if the gift does not become chargeable, what's the point of taking BPR? It's not chargeable. So for lifetime gifts, BPR is available again on the death calculation, provided asset is still relevant business property at the date of death, donor still owns the business property or replacement business property at the death of the donor's death or the death of the donor's death if the donee predeceases the donor. That means if the donee dies before the donor. So at the time of the donor's death, donor is still having the asset. If these two conditions are not satisfied, remember both, it's an and condition. Both condition has to be satisfied. Should be a relevant business property at the date of death and they should own it also. Either the donor's death or either the donor's death. If these two conditions are not satisfied, BPR is withdrawn and is not available in the death calculation. Very simple. If BPR is withdrawn on a chargeable lifetime transfer, the original chargeable amount including relief is used for NRB new resident ban accumulation. Remember, in CLT, in PET there is no issue because PET is not chargeable during lifetime. But CLT was chargeable during lifetime with BPR. But during death, if BPR is withdrawn, then that for that nil residence band, we use the original chargeable amount including the BPR, including the relief. So that later on the issue does not come. Whatever you have calculated as chargeable amount to be carried forward, that amount only will be used against your nil resident band accumulation. So things are kept easy. Now, with that we finished BPR. Now we are moving on to the next relief, agricultural property relief, APR. We have to know how all this relief works before we move on to the death state computation, because in death state computation we need it. That's why. Now, in death state computation we don't have this relief, but some reliefs are there. Now, APR is very similar to BPR. That's why study BPR before APR. If you understood BPR, you will understand APR with few differences. But this relief, APR, gives relief for transfers of agricultural property. In business property, it was business property. Here it is agricultural property. Very easy. So the relief, again, automatic. If conditions are satisfied, no claim required. Reduces the transfer of value by 100%. See, there is no 50-100 like BPR. APR is 100%, either 100%, either no APR. This also applies to both lifetime and death state. And on lifetime gifts, APR is deducted from the transfer of value first before any other exemptions and reliefs, including BPR. Now, these are the conditions. Two key conditions. First, has to be a relevant agricultural property. Second, has to be held for a minimum period of ownership. Same like BPR. That's why I'm going a little faster here. Relevant agricultural property. So APR is given at 100% on the agricultural value of the agricultural property. What is agricultural value? It is the value of the land and buildings, assuming there is a perpetual covenant on the land, permitting any other use of the land other than agriculture. That means there is a rule, covenant, that is saying this land can only be used for agriculture. Then that is known as agricultural value. Because sometimes land could be used for commercial reasons also, right? Or land could be partially for commercial, partially for agriculture. So only the agricultural part is applicable for APR. Okay. It is likely that the commercial value of the farming land and business will be considerably higher due to its development potential. Yes, commercial value is higher than agricultural value because they have more development potential. So the difference between the market value of the business and the agricultural value is referred to as development value. Agricultural property is defined as agricultural land and buildings. Agricultural property includes farmland and pasture, farm buildings including farmhouse, cottages, barns, pig sheds, milking parlors. Unlike BPR, remember the difference. Why the difference is APR is not available on your worldwide agricultural property. APR is only available if the property is situated in UK, EEA, or the Channel Island or Isle of Man. But BPR could be situated anywhere in the world. BPR is available. As with APR, BPR is not available if the asset is subject to binding contract for sale at the date of transfer, same like BPR. APR at 50%. APR is available at 100% on most agricultural property. But yes, as I told you, agriculture also 50%, but only for few. However, only 50% relief is available if a farm is a tenanted farm. That means you are giving it as a rent. Or the lease was taken out before 1st September 1995 and at the date of transfer, the owner does not have the right to obtain the vacant position within the next 2 years. What is the minimum period? If the agricultural property is farmed by the owner, minimum period is 2 years. If it is by tenant, 7 years. There are some exceptions to the minimum period. What are the exceptions? Same exceptions like BPR. Replacement property provision and successive transfer rule. So go to BPR, go through replacement property and successive transfer rule. Same applies for APR. However, replacement property rules are slightly different. Here, APR is available where individual owns some type of relevant agricultural property for a combined period of ownership of at least 2 out of last 5 years, at least 7 out of last 10 years. 2 if it's owned by farmer, 7 if farmed by tenant. Interaction of APR and BPR is very important. This will be asked in ATX if we are given both the reliefs. You have to know the interaction of the reliefs among each other. Not just for IST, any reliefs, whether under CGD, corporation tax, VAT, income tax. Now, where agricultural property forms part of an unincorporated farming business, you see unincorporated business, you will get BPR, but agricultural property will get APR also. So you are given both APR and BPR. Where you are given both APR and BPR, what happens? APR is given before BPR. So A before B. If you forget in your exam, always remember A comes before B. So APR before BPR. Okay. Double relief is not available on the same value. Same value means unincorporated business part is for BPR. Agricultural property is for APR. Okay. Both will not give on one value you will not get 2 reliefs. You are getting the 2 reliefs on 2 separate values on the same asset. So APR is available on agricultural value. Therefore, subject to the relevant conditions for BPR being met, BPR will then be available on any value of the remaining business at the qualify. So first you give APR on agricultural value. After that you see whether still there are some conditions that are being met for the remaining business assets that could qualify for BPR. So anything that does not qualify for APR, you see whether qualifies for BPR and give BPR. Otherwise, no BPR. Note that if the farm is tenanted and it is not the owner's farming business, no BPR is available. Very easy. It has to be your own. If it's tenanted, BPR will not be available. So BPR is not available on the remaining business assets as they are investment assets, not the owner's trading assets. Anything to do with BPR has to be trading. This you remember very well. Then you will never make a mistake in your exam. Anything to do with investment, not owned by you, no BPR. Now let us do question. Test your understanding 8. So in test your understanding 8, we have to calculate the chargeable amount of Zach's gift to his grandson. Now, here Zach plans to gift his farming business of 20,000 cash to his grandson on the occasion of marriage. He has made no other lifetime gifts in the preceding 7 years. The reason why they give this is for you to see whether they have utilized the nil rate band or not. That means full 325,000 is applicable for this gift. Zin lives on the farm and has owned and worked in the business for the last 17 years. Now, agricultural value is 600, development value is 400, and animal inventory is 150, plant and machinery and motor vehicle 80. So total is this one. Now, you have to find the transfer of value. When we are finding the transfer of value, there are two things. One is for farming business and the other one is for cash. Okay. So transfer of value. One is for farming business and the other one is for cash. So the cash is, it's given here as 20,000 and the farming business is this one. There are two separate this thing we have. Okay. So 1,230,000 and 20,000 we add and is 1,250,000. Now we will be deducting all our reliefs. So here we are going to have less what? APR, agricultural property relief, because we have an agricultural value. So agricultural value will be 100% on this amount. Remember, it's only on agricultural value. Okay, not on the development value. So it is 100% of 600,000, which is 600,000. And remember, APR you have to deduct first before any other reliefs. Next is, now we'll deduct BPR on any remaining value. So BPR will be on this 400,000, on this 150,000, and on this 80,000. Motor vehicles, animal and inventory, and market and the development value. APR only comes on agricultural value. The rest all is BPR, and you will get BPR. The reason is because you have owned it. You have to work there for 17 years. Therefore, you're going to get BPR on the rest of the value. So now 400,000 plus 150,000 plus 80,000 into 100%. Because it's an unincorporated business, so you will get 100% of BPR is 630,000. Next, this is due to marriage allowance. Now you will deduct your marriage exemption and annual exemption. Marriage exemption, it is a grandparent to grandchild. Always see the relation, who is giving gift to whom. If it's for other relatives, it's 1,000, but since this is grandparent to grandchildren, direct descendants, how much it would be? 2,500. It is 2,500. This limits were there in the previous lecture. Then we have annual exemption, current year and previous tax year. So 3,000 and 3,000. Annual exemption comes at the end. Then we have 11,500. So this is your gross chargeable amount. Okay. And now, so since the calculation here is calculate, you just have to calculate. You don't have to give reasons. But if they tell you to give reasons why this are available, how APR is available, on what, why BPR is available, then you have to give reasons. So I'm not writing the reasons, but I will tell you the reasons why. See, development value of the firm do not qualify for APR. Okay, farms, animal, inventory, farming equipment, they do not qualify for APR. Only the agricultural value. Number one. Number two, it is an unincorporated business. It has been owned and has been worked for more than 2 years. That's why BPR is available. Now, but if the farm was owned and then it is let to tenant, then APR would be available on the agricultural value. But BPR would not be available on the remainder. because this is not lent to the tenant, it was owned. That's why APR is also available. PPR is also available on remainder. Okay. Shares in a farming company. So now APR is available in respect of shares in a farming company, provided individual has control of the company. Control means more than 50%. Minimum period of ownership is satisfied. Note, related property holdings will be considered when we are determining control. To see whether you have control or not, related property holdings will be considered. See above. Related property holdings I have discussed before. So you have to see the rules that has been given before. APR is only available against the agricultural value that can be attributed to the shares. Then BPR will be given on the remainder if conditions are satisfied for BPR. APR will be restricted when the farming company holds accepted assets in the same way as for BPR. How BPR are restricted when we are having accepted assets, same APR will be restricted. Now let us do a question. Illustration 3. Now calculate the gross chargeable amount of gift to Jada's daughter. So here Jada owns 75% shareholding, an unquoted trading company which owns farmland. So since 75% shareholding means control is there. Okay. Now farmland and other assets. You see she has other assets means accepted assets are there. Because accepted assets are there, APR will be restricted. Okay. She's gifting shares worth 375,000 to her daughter. Farmland has been let to the tenant. Very important information. Whether it is owned or let to the tenant. This is important for BPR for the previous 9 years. Agricultural value is 300,000. Other assets is 150. So out of this farmland, 350. Agricultural value is 300. Other assets is 150 only. Okay. Were all used in the trade. So now, first let us decide what is available. APR will be available or not. It will be available. Okay. Because controlling shareholding is there. Number one, controlling shareholding. Number two, farm land has been let out for the previous 9 years. Two reasons. And in addition, shareholding is what? It is in an unquoted company. Unquoted. Very important, unquoted company. So because it is unquoted company, BPR will be available. It's an unquoted trading company. BPR will also be available. Wherever APR is not, we are not giving APR, BPR will be there. Provided if BPR conditions are met. Now, transfer of value. Okay. So we always start with transfer of value. So transfer of value would be what? 375,000. 375,000 is the transfer of value. Now, less APR. Less APR. So APR will be restricted. Please know that. How much is the agricultural value? Agricultural value 300,000 out of the total asset 500,000. Because for accepted assets we don't give APR. Into, remember APR is only restricted to this 375,000 attributed to the shares transferred into 100%, APR 100%. So it is 225,000. Now coming to the BPR. Always APR first, then BPR. Do not forget this step. Don't give BPR before giving APR. Otherwise, you will make a mistake. 1 mark you will lose. Same BPR will be restricted. How much? Out of 500, 150 on the other assets. Into 375. Same. But only for the shares. It's to 100%. Next. What's next? Annual exemption. Annual exemption current year, current tax year and previous tax year. Do not forget this. So it's always 3,000, 3,000. Many students forget this annual exemption part. If you don't, you will not get the gross chargeable amount. So 31,500. This is the gross chargeable amount. Okay. Now, one more thing, very important thing that you have missed out. If you see here, you have given 300 and here it's 150, but there is still 50,000 remaining. No, what to do with this 50,000? Why didn't we give BPR for this 50,000? See, out of 350, 300 is agricultural value. That means 50,000 will be the development value. Now tell me why we didn't give BPR for this 50,000. BPR will not be available. Why? Because if you see the information, this farm was not owned. It is let to the tenant. It was let. It was tenanted. It was not owned and farmed by Arable Limited. That's why we are not giving BPR for that development value. Okay. So BPR is only available for other assets because they have been used in the business. They told that other assets of 150 were all used in their trade. That's why we can give BPR. Next, we have withdrawal of APR on death. In same way like BPR, if conditions are not satisfied at the date of death, APR will be withdrawn. When you are calculating IHT payable on lifetime gifts due to the death of the donor. For lifetime gifts, conditions for APR are considered at the time of gift and APR is given at the appropriate rate when you are calculating chargeable amount of CLT or PET. Now, if the gift becomes chargeable on death, APR must be considered again at the time of death. So all these are repetition. It's just before it was BPR, now it's APR. So again we'll calculate APR on death. Provided asset is a relevant agricultural property at the death and donee still owns the agricultural property or replacement property at the date of donor's death or at the death of donee's death if donee dies before donor. Same like BPR. If these two conditions are not satisfied, APR will not be given at that calculation. Then if APR is withdrawn for chargeable lifetime transfer, remember for the nil resident bed accumulation, we are using the original chargeable amount only with the relief. That means with that APR. Because during lifetime we gave the APR. It is only at the time of death. But for CLT, gross chargeable amount, we are carrying forward using the nil rate band at the time of gift. That's why we don't take the relief at the time of when they are alive. Okay, during their lifetime. We take the relief at death. But because NRB calculation we do at the time of gift, so we are keeping the original amount with the relief. So no confusion in that one. You don't have to change it again. Now, so with this we have finished the reliefs that is available for lifetime and death transfer. There are two main reliefs that we went through. Now let us summarize both of them. One is BPR, the other one is APR. So BPR is automatic, APR is also automatic. BPR is given on lifetime gifts and death states, same for APR. You can deduct at 50 or 100% before exemptions and other reliefs like annual exemption, marriage exemption. And APR you deduct 100% before exemptions and other reliefs. BPR must be relevant business property held for at least 2 years. This also has to be this relief. APR is given for the agricultural value of agricultural property. Remember, when they are giving you the value of the farmland, do not take the development value with it. Okay, only the agricultural value. In the exam, you will be given the agricultural value. And property must be held for at least 2 years out of the last 7 years. Okay, at least 2 years and 7 years if tenanted farm. Remember, if it's tenanted farm, you will not get BPR on the remainder. If it is owned only, you will get the BPR on the remainder after getting APR. Now, BPR, it qualifies for the worldwide business property. APR only qualifies for the property in UK, EEA. For BPR, it must be a trading business, no relief for expected assets, and BPR may be withdrawn if conditions not satisfied at death. Same way, APR also may be withdrawn if conditions not satisfied at death. So this is very easy. Now, coming to the death state computation, very, 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 very important. Please put a double star mark somewhere. You are definitely going to get a question on death state computation, but you will not get a question where you have to calculate the whole death state computation. because you are in ATX. This is not taxation where they will ask you the number crunching or you have to calculate the whole death state. No, maybe they will provide you a death state. You have to do some adjustments. You may have to explain some numbers, or maybe you have to do partially. But knowing the full calculation is good, so that you know where you have to put the relevant things. So we are going to go through death state computation one by one. Now, death state means all the assets that is held at the date of death. Okay, every person who dies, donor will have a death state. Whatever the value of the assets and liabilities, the time of death, that is known as death state. So here you bring all your assets, okay, and normally the assets will be at the open market value at the date of death. It is also known as probate value, probate. However, there are special rules for valuation of some assets. We have seen that quoted assets, unquoted shares, the unit trust, relevant property. So the gross chargeable value of an individual's estate is calculated using the following pro forma. You have to know this pro forma. Pro forma is very important. So first, let's see the property value. From the property, deduct any repayment or interest only mortgages. Okay. Then foreign property. I have put a star mark next to a foreign property. There is a reason why. I will explain you later. If you have any foreign property, that also will come there. And first property is your local property, whatever you have in UK. Then you deduct the expenses. Remember, restricted to the maximum 5% of property value. Then any business owned by sole trader partnership, you add. Farm, you add. Stocks and shares including ISA, you add. Government securities, insurance policy proceed, death in service policy, cars, personal chattels, deaths debt due to the deceased. Sorry, death due to the deceased. You are going to get the death. You are going to get the interest and rent. Your cash at bank and deposit. All this will be added, and then you will deduct your debts that you are going like it is due from you by the deceased to someone else. Any outstanding tax, income tax, capital gain tax, funeral expenses. Remember, it is not the executor's fees, okay? Or allowable expenses you can deduct. Then any exempt legacy, like to the spouse, charity, and political. Remember, exempt legacies are only three: spouse, charity, political party. To anyone else, it is not exempt legacy. Then it is known as net pre-state. Then you add, if you have any gift with reservation, you add it with net pre-state, and the result is known as gross chargeable state. You will not be asked all this in the exam, but knowing it is good because you'll be given some of it. So now note that. So we have finished the pro forma, and from that note, wherever I put this asterisk mark for foreign property. So let's go back. You can see in the foreign property, farm, stocks and shares, business owned by sole trader. So there are four places where I put the asterisk mark. Foreign property, business owned by sole trader, farm, and stocks and share. The reason is because these items might be reduced further by BPR or APR if conditions are satisfied. Only those four. No cash, no chattel, no car. You can't reduce anything from them. All net assets are included in the state, including cars, ISA. See, cars, ISA, they are exempt assets for your CGT and income tax, but here it is included as there are no exempt assets for IST. For IST, no exempt assets. All assets are there. Now, the IST liability will be calculated like this. All this was the state value. Now, IST on chargeable state. Deduct quick succession relief and calculate the average state rate. Average state rate will be calculated like this. Whatever you have got XA divide by chargeable state into 100. Then you deduct double taxation relief. Double taxation relief is lower of overseas tax offered and AER into overseas property value in state. If you're not understanding this, don't worry, we'll do questions and then you can come back and see this formula once again. It will make sense. Then it's your IST payable. But this thing is very important. You should know it. You should know this quick taxation relief. You should know how to calculate AER, very important. Double taxation relief, very, very important. Okay, the XA is very important. Now, due date. So the due date is earlier off, 6 months after the end of the month. End of the month of death. You can die any day, maybe 15th of November, but the date will be taken from the end of month, that is 30th of November. Then add 6 months to it, or on delivery of state accounts to HMRC, whichever is earlier, that is the due date. Allocation of IHT payable. The IHT payable on the state is apportioned between different elements of the state at the AAR after QSR. And the tax on a gift with reservation. If it's a gift with reservation, the tax on that will be payable by whom? Beneficiary who is receiving the gift with reservation. The remaining tax will be then be paid by the executor. However, where there is an overseas property, it is apportioned between UK and overseas element of the state. Then, tax relating to overseas after DTR is recovered from the persons who is inheriting that asset, whoever is the specific legatee. And the gift of a foreign property from a state is therefore referred to as a tax bearing legacy, because whoever is taking it has to bear the tax. That's why tax bearing legacy. Whoever, if you're gifting a foreign property, it will be a tax bearing legacy. And the remainder of the tax relating to the UK asset is paid from the state. And so it is borne by the person who inherits the residue of the state, whatever is left over, after the specific legacies has been paid, known as the residuary legatee. If you are the last to inherit after all the legacies has been paid, you are known as residuary legatee. Accordingly, the specific legacies of UK assets do not bear any tax and are referred to as a tax-free legacy. It is the residuary legatee who has to bear the tax. So you are free from tax. Now, these are the allowable deductions. We'll go one by one. I went through funeral expenses and said you can deduct. Okay. Remember, the cost of individual's funeral are allowable provided they are reasonable, even though the cost is incurred after the date of death. If you are incurring this cost after the date of death also, it is allowable. Reasonable cost of mourning clothes for the family and the cost of tombstone are also allowable. Next, expenses administrating the state. Whatever the cost is there to administrate the state, you can deduct. For example, any cost that you are paying to the executor or personal representative. The cost of administrating the state by the executor and personal representative is not an allowable deduction. Why? Because it is a professional services that they carry out after the death. So you can't deduct. Next, other allowable deductions. Debt. If you are having any outstanding debt at the date of death, you can deduct. And it has been incurred for a valuable consideration or imposed by law. That means law says you have to pay it and it's something of valuable amount. Okay. Then let's say you have promised to pay someone else. So that promise was verbal. Nothing was written, no legal enforced. Then you can't deduct. It's let's say it's a amount of 50,000. Okay. And so it's a legal enforceable debt. It's a for valuable consideration or it was imposed by law. Yes. Now, so a promise to a friend is not a legally enforceable and therefore not deductible. Gambling debt are also deductible if you can legally enforce them. Let's say an amount owed to a casino. Okay. And not enforceable. See, it could be enforceable if it's, let's say, an amount owed to a casino. But let's say an amount owed to a friend in a gambling, then that's not enforceable. That's not legally enforceable, so you can't deduct. So this will include all outstanding taxes. In the allowable deductions, you can deduct income tax, NIC, CGT, although no IST due on death itself. Okay, all the other taxes, income tax, NIC, CGT, you can deduct. If a debt is secured against a specific property, that debt you can deduct from the value of that property. Usually this will be the case with the repayment or interest only mortgage. secured against property. This was the first thing we saw in that pro forma, right? From the property, we deduct a repayment of interest only mortgage. So again, go back and see the debt state pro forma. Now, exempt legacies. The only exempt legacies that are allowable in the debt state are gifts to spouse, charity, qualifying political party. And the reliefs are BPR and APR. Again, you can use in the debt state to reduce the individual's debt state. Now, transfer of ISA on death. Very important. On death, if ISA savings are left to the spouse, the gift is exempt legacy because you are leaving it to the spouse, no? And in addition, whoever is alive, the ISA allowance equal to the deceased individual's ISA savings can be claimed by the surviving spouse. This is an advantage. In addition to your ISA, you can take your deceased spouse's ISA allowance also. Could be transferred. As a result, deceased individuals' ISA savings will retain their beneficial tax treatment. How? See, whatever deceased individual has, their ISA savings will get the tax benefit. What? It will be exempt from income tax and CGT. In the hands of the surviving spouse. The surviving spouse will get that beneficial tax treatment on the ISA savings of the deceased spouses. That means forever in the future. It will always be exempt from income tax and capital gain tax. Next, note that surviving spouse is entitled to this allowance, this ISA allowance, even if the ISA assets are left to someone else. Spouse can claim it. If this is the case, let's say the ISA assets are left to someone else, you are taking the allowance, spouse, what happens? There will be no exempt legacy in the death state computation. But because the ISA assets are left to someone else, no? So it's not an exempt legacy. But the surviving spouse will be able to invest an additional amount of fund into an ISA to benefit from the ISA exemptions in the future. That is, I think, up to 20,000, right? Now, so with this, we have finished the death state computation. Now we'll be doing a question on death state computation. Before we move on to our last part of this lecture, that is special valuation rules affecting death state. Test your understanding 9. You have to calculate IST payable on Tom's death. Here he has some of the assets: house, cottage, unincorporated business, bank account, quota shares in trading company, and car. Remember, none of them are exempt for IHT, but two things. One is unincorporated business and quota shares in a trading company. Why I've highlighted? You might get BPR on that. Let's see. At the date of death, owed 2,000 on his credit card, 3,000 of income and CGT, owned the business for 20 years. In Tom's will, he left the business, the house, and the share to his wife. Remember, wife is an exempt legacy. Okay. The cottage to his brother, the residue to his sister. Tom made a lifetime gift of 115 in cash to his son in August 2019. It's within 7 years. Okay, and it's a pet because it is to his son. When did he make the gift? August 19. And when he died? 30th June 2023. So if you take the date 30th June 2023, it is less than 4 years. Okay, between 3 to 4 years. Now, death state computation will go one by one. So first we'll write it's a death state. Okay, so we start with house. House will go there, cottage will go there, unincorporated business will go there, and from unincorporated business you can deduct the BPR. Okay, because the business was owned for 20 years. Okay, and is unincorporated, so 100% BPR will be available on that. Then bank account will be there, quoted shares. For quoted shares, okay, we'll see whether a BPR will be available or not. Are we going to get BPR for quoted shares? No, they will not qualify for BPR. Why? Because Tom does not have a controlling interest in the company. How do you know that? See, unless the question says or gives you a percentage greater than 50 or say they have a controlling interest, always assume they do not have a controlling interest. So because they do not have a controlling interest, no BPR for quoted shares. Okay? For because it's a quoted share, you should have a controlling interest. Because controlling interest is not there. Given, assume controlling interest, you do not have. So no BPR for quoted shares. BPR is only available for this one. Then after car, deduct the expenses. What are the expenses? Credit card, 2000 expense. Is it allowable? Yes, it is allowable. Income tax, 3000. Is allowable? Yes, it is allowable. Then any exam legacy. Remember, anything to his wife, the business, the house, the share, all you can deduct. Okay. So now let us quickly do that. Okay. So let's quickly calculate that. So just copy paste the value from there. House, cottage. Then we have unincorporated business, UBL, right? And from unincorporated business, from the place itself, deduct BPR. What you are deducting, you have to write. If it's BPR, write BPR. If it's APR, write APR, whatever it is. And always write the percentage. It's very important. 100%, because it could be 50% also. So do in the outside column. In the Excel, do it in the outer column. 200. Cottage was 250,000. And anything, if you have to deduct, do it in the inside column like this. Since you have to deduct from unincorporated business, writing unincorporated business amount inside, because you have to deduct 400,000. Don't do addition deduction in one line. Then it will be 0. Then we have bank account. Then we have quoted shares. No BPR. If no BPR, make a note. Normally, if an amount, you see, could be applicable for BPR and conditions are not satisfied, always make a note and write it down. Why you are not giving the BPR? Car. Okay. So 75,000 is the bank account. 100,000 is the quoted share. Then 15,000 is the car. Then we are done with it. Assets. Now we'll deduct the expenses. Credit card, income tax and CGD. It was 2,000. This you can deduct outside because they are expenses, and 3,000. Then you are left with 635,000. Value of the state till now is 635,000. Do not forget the exam legacy. This is why you need the pro forma. Since I went through the pro forma, I know I have to deduct my exempt. Write exempt. Don't write to wife. Why we are deducting wife? Because exam legacy to wife. Okay, what are the things? House, shares, quoted shares, QS, and unincorporated business. So how much was the house? 200. Quoted shares 100. Business, because we have earlier deducted BP. You see here, we have deducted 400, so it will be 0. House will be 200,000. Same. But when we are deducting unincorporated business, remember it is 0 now. After deducting BPR, you have to take from exam legacy. It is 0. So now you are left with 335,000. This is your gross chargeable state. GCE. Don't write GCE, write gross chargeable state. Now, what do you have to do? You have to find the IHT. You have found the amount. But to find the IHT, what do you need? There was a pet. You have to find your NRB, the nil residence bed available. To find the nil residence rate band available, there is a working. Okay, keep some space. Do not show working in the main table. Always in the exam also follow this technique. Okay, working lifetime gift to son. Okay, so there's a transfer of value. How much he has given to the son? There was a pet, and that pet have utilized the new residence. Sorry, not residence, nil rate band. That's why I want to know how much of the nil rate band I can utilize. 115 was given as a lifetime gift. So 115,000. From here you will deduct annual exemption 3,000 and 3,000, and it will be pet 109,000. That means from 325,000 you didn't pay any lifetime tax. This was pet. You have utilized this much. So 216,000. That means out of 325, 216,000 nil rate band you can utilize again the gross chargeable state. You see? So now, how much was the gross chargeable state? 3. From here, 335,000. Now deduct the residence. Sorry, not. I always keep on saying residence. NRB, nil rate band. Nil rate band is now 216,000 because of that lifetime gift you have made to the son. Into what rate? You have not made anything to charity or anything, so death tax is 40% IST. So 47,600. This is your amount of IST chargeable on the IST on chargeable state. Okay, it isn't so difficult. It's very easy. Trust me, IST is one of the easiest. Okay, the thing is, it has a lot of workings to do, a lot of things, technical areas to be remembered. That's it. Land and freehold property situated in UK. See, there are special rules if you are having a land and freehold property situated in UK. When the land and property is owned by two or more individuals, they own the property either as joint tenant or tenant in common. Okay, that means on the death of a tenant, the tenant's share is inherited. If it's a joint tenant, automatically it will be shared by the other tenant. And if it's a tenant in common, then it will be in accordance with the terms of the deceased tenant's will or in accordance with the rules of intestacy. Now, so the valuation of the UK land and property in the state computation is the appropriate portion of the value of the whole property for joint tenant. Usually, this is one half of the whole as they are normally two joint tenant. If you're having joint tenant, you normally divide it by 2, the value of the property. So for tenant in common, the value is negotiated and agreed with HMRC, but for your exam, always the value is 10% lower than the open market value. Always deduct 10% from whatever the open market value given to you. Now let us do questions. Illustration for tenants in common. A brother and a sister jointly owns a property as tenant in common worth 500. Calculate the value of the brother and sister shares in the property for IST purposes if they were to consider making a transfer of their share in the property. So because the value of the property, the value of half the property would be on a standalone basis. This is the open market value of the half share on the open, which is unlikely to be 50% of the whole value. However, who would buy a half house? So the capital tax deduction of HMRC accepts that a tenant deduction will be between 5 to 15% from the open market value. But for your exam purpose, always assume a deduction of 10%. Okay, normally it's 5 to 15% you can deduct, but we'll take deduction of 10% always. So because it's 500 divided by 2, 250, and deduct 10% of 250, which is 25. So this is the value of half the share for IST purpose, 225. Life assurance policy. The next valuation is in the life assurance policy. So first we have to see the terms of policy, then we'll decide on the valuation. If the life assurance policy is taken out on one's own life, then the value that you have to include in the state is the actual proceeds received by the state. Very easy. Next, if it is taken for the benefit of a named beneficiary, let's say you have taken the assurance policy for your spouse or children, then value to include in the state, it is excluded from the state. Note, for a service in death, death in service policy, example, where you have taken an insurance policy for an employer, where the insurance policy is taken out by an employer on the life of an employee, and if the employee dies, then the insurance company will pay out a lump sum to the beneficiaries of the state. So this lump sum forms part of the deceased death state. This is known as death in service policy. Why death in service policy? Because a person has to die on whom the insurance has been taken. The person has to die for this policy to work. So if the beneficiary receives this lump sum will also be taken in the deceased death state. Next, reduced rate of IST for legacies to charity. I've mentioned this briefly in my previous lecture. I've told you it will be explained in detail why and how. And normally IST rate is 40%. But the reduced rate, if the legacies are left to charity, is 36%. But this 36% will only apply if 10% or more of the baseline amount is left to the qualifying charity. What is this baseline amount? The baseline amount is the taxable state. After you deduct your exemptions, your reliefs, and your nil rate band. Remember, deduct exemptions, reliefs, available nil rate band, but before you deduct your charitable legacy and residence nil rate band. This you have to remember. It's not given in your formula sheet. So this baseline amount, you should always remember the baseline amount. Then only you can take the 36% rate and all. So this is how you apply the tax. Always when you are given the residence nil rate band, add back, because they told before you deduct. See, when you are getting the gross chargeable state, no, they have already deducted the residence nil rate band and charitable legacy. Now you have to add them back. So add back your residence nil rate band and charitable legacy to the taxable state. This is equal to your baseline amount. On that baseline amount, take 10% of it and compare this amount to the amount that is amount of charitable legacies left on death. The charitable legacy left on death amount will be given to you in the exam. With that, you have to take 10% of the baseline amount and compare. So if the 10% of the baseline amount is greater than that charitable legacy, apply 36%, and if it's less, then it's 40% rate. Very easy. So if your charitable legacy is greater than or equal to 10%, 36%. If your charitable legacy is less than 10%, 40%. Now tax planning. How can you save your IST? Planning means always saving tax through some planning. IST can be saved if you increase your charitable legacy, because then you have to pay more of 36% rather than 40%. You are saving 4% tax. And if it is not in the will, you can use a deed of variation, where you make sure that your charitable donation exceeds the 10% and thereby reduce the tax on the whole state to 36%. Now let us do questions. We have two questions, test understanding 10 and test understanding 11. Test understanding 10 specifically on the reduced IHT. So calculate the amount of IHT as a result of hand's death. Test understanding 11 is a question where you are given a multiple scenario. That means all what you have studied till now on IHT is given. It's a full comprehensive question. You can say it's a lengthy question. Okay, so calculate IHT that will be payable as a result of the Wilma's death. Explain who will pay and who will suffer the IHT liability. And you have some 8 points. So let us first finish with test understanding 10. So you have to prepare the death state. He has family home, quota shares, cash. Okay, owns tax of 3,200. He in his will he will left the shares to his wife. This is, remember, exam legacy because wife. Family home to his children, so he can claim residence nil rate band. And 67 Oxfam, a UK registered charity. He made one lifetime gift to his son of Sweden. That means this will utilize as what? Nil rate band. And to his son, so it's a pet. Okay, so let us quickly add all these three: 445, 145, and 67. 657,000. So from 657,000, we'll deduct the due 3,200. So 657,000. Deduct 3,200, that's the due, and deduct the exam legacy. Exam legacy is only the share. Remember, there are two exam legacies now: spouse and the charity. How much to the shares? 145,000. And how much is the charity? 67,000. So gross chargeable state is 441,800. Now you have to calculate IST. To calculate IST, remember, gross chargeable state is this one. Do not forget, first deduct residence nil rate band before you deduct nil rate band. It's how much? 175,000. This amount is less than 2 million. So, and residence and nil rate band. Nil rate band you have utilized because you made one lifetime gift of how much? 310. But from this 310, don't you have to deduct the annual exemption? You have to deduct annual exemption 3,000 current year, 3,000 next year. So that means 310,000, 6,000 of annual exemption. That means 304,000. So out of 325,000, you have utilized 304,000. So that means your residence nil rate band is just 21,000. And now you deduct your taxable amount is 245,800. So 245,800. We'll see whether we have to apply 40 or 36% depending on the baseline amount. Now we have to calculate the baseline amount. So now remember, what is the taxable amount? This is the taxable amount. We'll do the working side by side here. We are calculating baseline amount. So taxable amount 245,800. What do you have to do with it? Add back charitable legacy 67,000. Add back residence nil rate band 175,000. And you get 487,800. Take 10% of it, 48,780. If you see this, what was your charitable this thing? Your charitable this thing is 67,000. So 67,000 is greater than your baseline amount. So the reduced rate of 36% will apply. So here to this taxable amount 24,500, you will apply 36%. You see, you have to do the working. Always baseline amount you have to calculate to get that rate. So then if you apply the rate, it's 88,488. This is the IHT. You see? That's it. Now test your understanding 11. Okay. So test your understanding 11. You have to calculate a long death date. You have been given lots of information. Okay. What are the assets that has been known at the death? So Wilma died 4th October 2023. Under the terms of will, 122 husband, 52 consecutive party. Remember, both of these are what? Exempt legacy. But out of this you have to take for 36 or 40. The residue of the estate to her son. Main residence 628. So residence nil rate band will be there. A flat in London 150. Wilma never lived in this property. 4 shops 50,000 each. Wilma's husband Fred owns 2 adjacent shops value 60,000 each. The combined value of 6 shops is this. This is for related property. A villa situated overseas 200. Exchange rate is this much. Fifth one, half share of the partnership business 400 in total. Partnership period in UK. Wilma had been in partner for several years. 20,000 shares. Share were quoted at this much. Bargain was given. Unit. It's a unit trust. They have given the price and bank balance. You see, they have given everything. Quoted shares, unquoted shares, unit trust, related property, bank balance, all the type of assets they have given. So here you have to apply some special valuation rules for some assets. Outstanding tax is 7,500. Funeral expenses is 2,000. No lifetime gifts. It's a lengthy one. So when we are given lengthy one like this, we'll do in order given. First, let us start with point number 1, 2, 3, 4 like that we'll go. Okay. Now, so we are making the death state. Death state. Main residence is 628,000. Flat 150,000. Shops, there's a related property. You need a note for it. Special valuation rules. So we'll go under the note 1. Working I'll keep here. Note 1. Shop. Related property. Remember that A divided by A plus B into this one. It's a related property. You quickly have to identify like this. Nowhere in the exam they will say this is related property or not. You have to understand it's related property. Okay. So now let's see. Donor. So this is done. This is done. We are in the third one. 4 shops valued at 50,000 each. So 4 into 50. Now 2 adjacent. So husband owns 2 adjacent shops at 60,000 each. Combined value of all the 6 shops is 370. Okay. So we have to take Wilma's as A. So 50,000 into 4 is 200,000. Divide by how much? This will be 200,000. Wilma's, but Fred owns 60,000 into 2. Husband is B. 60,000 into 2 into total 6 flat is 370,000. So what is the value? 231,250. This is the value you have to put here in the main table. 231,250. This is how you have to do the working in your exam. Villa. This is villa. For villa, come to villa. This is done. This is overseas property. It's in dollar. Exchange rate has been given. So you divide by 10. It's $200 and $10. If you want to convert it into pounds, you have to convert it into pounds. So 200,000 divided by 10. You don't have to do a separate working for it. You can just show it here like this inside the bracket. 200,000 divided by 10. 20,000. No issue. Coming next, partnership share. PS. Partnership share also. Next, so the fourth one we finished. You see, like this in order you can go. Partnership share half. So just take 400 divided by 2. But remember, this is partnership share. He has been in partner for several years. Because partnership, we can claim what? BPR. 100% you can deduct. So that's why we'll keep partnership share 400,000 divide by 2 inside the column, because we have to deduct BPR 100%. Okay, BPR 100%, so 200,000 will deduct inside. Rest all main residence, flash house, villa do not qualify for BPR. 0. Now, so this also we finished. Next is shares in ZAM PLC. It's a quoted share. For quoted share, what should we do? We'll keep a note to it. It's a special valuation rules again for quoted shares. So next is shares in ZAM PLC note 2. Another working. Okay. So we'll go here. Remember, it's a quoted share. Lower of markup and quarter up and average. Remember, quarter up is what? 198 and 206. This is the bargain. The shares were quoted at this with bargains of 196 pence. See, bargains we need in the average, okay? 198 and 206. So low price is 198 pence plus 1/4. This is the quarter up. High price is 206 and low is 198 pence, 200 pence. This is the result of average. So quarter up. Average is the highest and the lowest marked margin. So half into highest and the marked margin. If they don't give the margin, then we'll simply take the 198 and 206. But since they have given you the margin, what is the lowest? 196 and highest is 208. Okay. So 196 pence plus 208 pence. 202 pence. The low is this one, average. I'm sorry, I always confuse the average. It's quarter up, 200 pence. So we have to use 200 pence. How many shares? 20,000. So 20,000 into 200 pence. Or simply 2 pounds. So it is 20,000 into 200 pence or 2 pounds. It's the same, 200 pence. It's 40,000. Now, done. Next, unit trust. Remember, unit trust is the low price. Lowest this thing. So 130 pence. And it's 8,000. And bank balance as it is you can take. So unit trust 8,000 into 130 pence means 1.3 pounds, which will be 10,400. And bank balance as it is. So we have finished all the 8 points. 57,850. Add is 1,137,500. Now deduct the expenses. Income tax and funeral expenses. So income tax is 7,500 and 2,000 is the funeral expenses. Deduct the exam legacy. Exam legacy is also 2, spouse and charity and political, husband and political party. Husband how much? 120 and 50. Husband, political party. Total is 958,000. Gross chargeable state. Now from here 958,000 thousand. We'll deduct residence nil rate band because it has been left to the son. And nil rate band 325,000. We'll see. So whether we have made any gifts or not. No lifetime gifts. So entire 325,000 nil rate band is available. So the moment you deduct residence nil rate band and nil rate band from gross chargeable state, it is taxable amount 458,000. Taxable amount. This is very important for your baseline. Whether it is 40, whether the income inheritance tax is 40 or 36, now we'll calculate baseline amount and see. Okay. So now see you later. Explain who will pay and who will suffer the IST liability. This also you have to write further to this. Okay. Okay. So here they have not mentioned anything about charity. This is to the consecutive party. I'm sorry, 50,000. I've made a mistake in the first, so they have not made anything to the charity. It is to the political party and husband. So nothing to charity. So tax rate is at 40%. This is at 40%. So 183 to 100. This is the IHT. Okay. Now the tax will be paid by the executor and it will be suffered by whom? Whoever inherits the residue of the state. It is joy. The son. You see here? The residue of our state is son joy. So he will suffer the tax. That's it. Relief against IHT liability on death state. How we have reliefs for lifetime gifts and on the death of the donor we have same on the death state. Now there are two tax credit reliefs that reduce the IHT liability on the death state. So here one is quick succession relief, one is double taxation relief. First we'll deduct QSR from the IHT. See, we have stopped at IHT on chargeable state. Till that we know how to calculate. Now you further deduct QSR and DTR and get your IHT. Next is quick succession relief. Quick succession relief applies when an individual dies. See, this is new for ATX, okay? It was not there in taxation, so I will go a little slow. Quick succession relief means when an individual dies and within the previous 5 years they had inherited an asset on someone else's death. That means there are two deaths, one after the other. Succession, he dies, then he dies. So during that time, they inherit an asset and ISU was charged on the inheritance, or received a lifetime gift and ISU was charged on the gift. The most common situation is where two members of a family die within 5-year period. First person to die having made a bequest to the second person. You see? So the QSR is a tax credit against the IHT liability of an state on the death of individual receiving the asset. Whoever is receiving that asset, against his tax, there will be a tax credit. Now, so the amount of QCR where two deaths occur within a 5-year period is calculated like this. Take the IHT on first death, apply the appropriate percentage. We'll see how appropriate percentages will get like this. It depends on the year. See, remember your tapper relief depends on from more than 3 years and less than 7 years, the death. Here, years between first transfer and the date of death. So if it's more than 0 but not more than 1, 100%. QSR is 100%. More than 1, not less than 2, not more than 2, 80%. More than 2 less than 360, more than 3 less than 440, more than 4 less than 520. So the more years between the first transfer and date of death, percentage reduces. You see, 100, 80, 60, 40, 20. In the taper relief, it was the opposite. So now you have to remember this. Now, so the IHT paid on the first death, either it will be given in the question or it can be calculated like this. Total IHT paid on the first death state divide by gross chargeable state value of the first death state into value of asset gifted out of the first. Following point should be noted. Appropriate percentages are not given in the question, that you have to do based on the death year, and closer the first transfer and the date of death, greater the percentage. Each additional year between the year reduces the percentage by 20. That's why 100, 80, 60, 40, 20 like that, you see. Now, it is not necessary for the individual who received the asset to still own that asset on the date of death. Even though the same asset is not subject to a double charge to IST, as it is not included in the second state. QSR is still available. This is because the second person's state will have a higher value following the receipt of the gift. He will receive the gift, so his state will have the higher value, whether the original property is retained, exchange for the other property, or is converted into cash. Whether you retain the original property, you exchange it for other property, you convert the property into cash, still your second person's state value will be higher because you're receiving the gift. So that's why QSR will still be available, even if the person who's receiving the asset does not own the asset on the date of death. QSR is given before DTR. Now let us do questions. Test your understanding. 12. Calculate IST payable on Reem's death. Reem died on 31st July 2023, leaving a state of 340, no lifetime gifts, have no residential property, had left 28 to her from her brother's state. Inheritance tax 75 was paid on a total chargeable state of 450 as a consequence of her brother's death. Now, so gross chargeable state value is 340. Deduct the nil residence ban, nil rate ban, no lifetime gift. So from 340, you can deduct 325,000 nil rate ban and get the taxable amount as 15,000. On this taxable amount, take the tax IST at 40%. You need the IST, okay? 6,000. Remember, if there has been nothing to charity, nothing to do with charity, no need to reduce the rate to 36. No need to find the baseline amount and all those things. It is only applicable. You have to read the questions. If anything to do with charity, then only. So this is a straightaway question. 6,000. IST on death is 6,000. You have to deduct what? You will get a QSR, quick succession relief. That quick succession relief you need to do a working. How? Remember, how much tax he paid on the first? 75,000. Okay? From the property of his brother, 450. Into what? Reem had been left 28,000 into 28,000. So quick succession relief working is like that. How much inheritance tax? 75,000 out of the property state value. Brother state was 450 into Reem was left 28,000. Just do that formula. To do now, you need the percentage. Quick succession relief percentage. You have to know the death. Died on 31st 2023. And which date he was left with the property? June 19. So from 19 to 23. 20, 21, 22, 23. 4 to 5 years. It's more years, no? 4 to 5 years. So there is nothing 5 to 6. It's only 4 to 5. So the last percentage, the lowest 20%. In case you forget, remember, if it's 4 to 5, is the lowest percentage. Lowest is 20%, not 0. So 933. So 933 is the quick succession rule if you deduct this from inheritance tax offering, which is 5067. 5067. So this is the IST payable on Reams state. So we have come to the last part of this lecture. Before I do two more questions and then summarize this lecture, that is legacies left on death and single grossing up. This also has a very high chance of coming in your ATX exam. Okay, so the terms of the person's will are very important in determining the amount of IHT payable on death. Exam legacy. Gifts to the following person are exempt from IST on death: to spouse, to charity, to qualifying political party. This you have seen previously. Where an exempt person is left a legacy in a will, the amount of the legacy is deducted in the calculation of gross chargeable estate. This we know. We have done questions. Now, specific gift to of UK assets left to a chargeable person. If it's to a chargeable person, then the IST on the legacy is borne by the residuary legatee, the person who is left the residue of the state, not the specific legatee who receives the asset. This you have to remember. It is not the specific legatee who receives the asset will bear the IST. It is the residue of the state. So the specific gift is a tax-free legacy. For example, if you are left 100,000 in your grandfather's will, you will receive all 100,000. The IST payable on that gift to you is borne by the person who is left the residue of your grandfather's estate. This will cause no problem in the calculation of IHT where the residual legatee is a chargeable person. However, if the residual legatee is an exempt person, what to do? Special rule applies to calculate IHT on the estate. Because you are already getting the benefit of exempt legacy, you are deducting it from the chargeable estate. Again, if it is a residual legatee, you're not paying IHT, so you're twice you are being benefited. So that they will not give you. That's why you have to pay IST on the state and special rule will apply. Exempt residue. Special known, if it's an exempt residue, special rules known as single grossing up are required. So, this is person gives from the state as follows. Specific gift of UK assets are left to chargeable person and the residue of the state is left to an exempt person. Then these rules will apply. So, to find the IST payable necessary to calculate the amount of chargeable asset that would be needed so that after the tax was paid, the amount left will pay the specific legacies. The total of the specific gift of UK asset is net chargeable estate. Accordingly, IST is calculated like this. This you have to remember. Net chargeable asset minus your nil rate band into 40 divided by 60 because you pay 40% tax. Note, the gross death rate of tax applied to the gross chargeable is 40 on the excess over the nil rate band. Therefore, the net rate of death tax is 40/60. Once the IST payable is calculated, you can get the gross chargeable estate. Now you are working backwards. Add your IST payable with net chargeable estate and get the gross chargeable estate. What do you do? Gross chargeable minus IST is net chargeable estate. Now you add. You are going back. So the amount that is allocated to the exempt residual legatee will be the balancing amount. Now let us do questions on this single grossing up before I summarize the lecture. The last two questions of this lecture are illustration 5 and 6. They are a little lengthy. Both are relating to single grossing up. So I will go through 5 a little slow and 6 a little quicker because they are similar nature. 6 is a little lengthier than 5. So we have two parts to 5. Gross chargeable state value, IST payable, and amount of the residue which will pass to the civil partner. So civil partner is an exempt residue. That's why single grossing up. Calculate how your answer would differ if Alan had made a gross chargeable lifetime gift of this much. Okay. So state value is 900, no lifetime gifts. She made the following gifts. 180 to her son. This is a holiday cottage. Never lived in the cottage. Legacy of 110, each in cash for her two daughters. Legacy of 50k to charity and residue to her civil partner. So let us quickly do that. Where do you start the question? First, from the state value. Always from the state value. State value is given as 900,000. Then you deduct your exam legacy. See, you don't have to deduct any debt, anything like that, because they have just given you, they have calculated the state value and given to you. So exam legacies are two. One is charity, one is to partner, civil partner. But remember, civil partner, they didn't give the value. It's a balancing figure. Balancing figure. Okay. Charity is 50,000. Okay. Now, they have given the value. But for charity, okay, you have to find out. For charity is given, civil partner is the balancing figure. For that, you need to know the gross chargeable state. To know this, you need to know the gross chargeable state. Gross chargeable state, you need a working for it. And hence, the IHT, also you need a working. So let us now first distribute the state. You have to do the distribution of the state. That means total how 900 is made, okay? Residue to the civil partner. Oh, just wait a minute. Okay. So gross chargeable state is 450,000. How? Just add all this. Okay. Gift to charity is 50,000. Cottage to son, 180. Then legacy to daughter. Daughter. Okay, I will just write daughter. 110. Two daughters are there. 220,000. And legacy of cash. No, wait a minute. Just so it's 400. Will not leave this. This adds up to 400,000. Okay. So here, civil partner is 400,000. Because your gross chargeable state is 450,000. And civil partner is 400,000. Because from your state value, okay, you need to deduct 450 to get the 450. This is the value of your gross chargeable state. That's why you are getting civil partner 400,000. See, okay, this 50 will be there. Gift to charity, I'm sorry. So 450,000. So this is the value of your gross chargeable state. Okay. Add the sum, this one and the gift to charity. So if you add up, it's 450. Value of the gross chargeable state 450. So from 450, 50 is to charity. That means the 400 will be to civil partner. You see, so 450. This 450, if you deduct from 900, that's how you get the gross chargeable state 450. Okay. Now, single grossing up you have to do working for IST. Okay. Specific chargeable legacies. Holiday, cottage to son. That is chargeable. How much? 180,000. Then legacies to daughter. It's 220 because 2 into 100, 10,000. Net chargeable state is 400,000. So from net chargeable we deduct NRB 325,000. That is the taxable amount 75,000. Remember IST. So 75,000 into 40/60 is single grossing up 50,000. So this 50,000 is the IST. Now the gross chargeable state is 400,000 is net, 50,000 is the IST, 450,000. This is how you get 450,000 as the state value here. This is working gross chargeable state. Then you go backwards and balancing figure. I'm sorry, not here. It's here. 450. This is the working. You go here and you get 400,000. I'm sorry. It's not how you have add like that. Distribution of the state is not the working. I'm sorry. Distribution of the state is after you do the single grossing up to see whether the state value adds up to 900,000 or not. We'll see how it adds up. How? Distribution. Sometimes they ask you in illustration 6, they ask you the distribution of the state. Residue to civil partner is 400,000. Through working we got. Then charity, give to charity 50,000. Then cottage to son 180. Legacy to daughter 220, 110 into 2, 2 daughter. And then finally IST on legacy. Just now we got it through single crossing up. IST on legacies to HMRC 50,000. If you add up, it's 90,000, 900,000. This is how you see whether all these are correct or not. This one and this one. You see? Now B. B. Assuming what part B, chargeable lifetime 267. How this would differ? The calculation. So coming to B, if you see, I will show in the part A itself. Here. So this remains 900, this remains 50, this will change. Civil partner will change. If gift balancing figure will change, gross chargeable value will change. Then IST also will change. But we have to show that. Net chargeable state will be 400,000 only. But now your residence nil rate band will change. So from 400, 325, because you made a lifetime gift of 267,000, your nil rate band will change to 58,000. So from 400, you did a 58, it is 342,000 taxable amount. And on this, it's 4060. The inheritance tax is 288,000. So, and this you add with 400, the net chargeable. So your gross chargeable becomes 628,000. Okay, so here it will be changing to 628,000, and then this will change to, rather than 400, it will reduce 222,000. IST will be 228. So this will change. The rest now distribute and see. Still it will add up to 100. The only thing is residue to civil partner reduced to 222 and IST increased from 50 to 228. Everything remains the same, so it's still 900,000. Okay, now coming to illustration 6. You have got the idea. So calculate IST payable on Tala's death. Show how state will be distributed between the beneficiaries. Show how the situation would change if the widow was left this much and Charbel was left the residue of the state. Charbel. Charbel is a son. Died on this date, leaving a state value 664. No residential property. Thala left to her son 331. And the residue of the state to her widow. That means exempt residue. No lifetime gifts. So now, we'll quickly do part A. Okay. State value 664. Always start with state value. 664,000. Deduct exempt legacy. EL. Who are the exempt legacy? Spouse. Only spouse. It's a balancing figure. We don't know yet. So because it's a balancing figure, first we'll find the gross chargeable state. Here's a working required. That means single grossing up you need, and IST. Both you will get through single grossing up. So first we'll go to working. Cash to the son. Whatever is cash to the son is net chargeable state. Only one this thing is there. That is 331,000. Only one gift is made. So cash to the son is equals to net chargeable state, which is 331,000. Only one gift. That's it. From here, deduct the residence nil rate band. No lifetime gift. So 325,000. Nil rate band. Then it is 6,000 is the taxable amount into 40 divided by 60. Remember the grossing up is like this, which is 4,000. So with this 4,000 you add this. You already got the IST 4,000. So 4,000 plus 331,000 is 335,000. This is the gross chargeable state. 335,000. So here how much you have to deduct from 664 to 335? Simply the difference between the two. 329,000 is the spouse. Now let us go to part B and distribute the state. So spouse is 329,000. Cash to son is 331,000. IHT is 4,000. If you add, it is what? 664,000. Just see, always add and see whether this is correct or not. Done. See, state valuation. Show how the situation would change if widow was left this much and chargeable was left the residue of the state. Here single grossing up will not come because it is left to a chargeable person. Video is left this month. This is exam legacy. Now we'll show. This is the normal situation. See. So state value is 664. From here deduct the exam legacy, that is 331,000, because now it is left to the spouse. 333. This is the gross chargeable state. No need to gross up. IST. So from here deduct 325,000. Nil rate ban. 8,000. No grossing up. Apply 40% tax. 3,200. This is the IST. Done. Now distribute the state and see. Cash to spouse. How much? 331,000. To son is the residue. It's the balancing figure. IHT is 3,200. So it is how much? What is the gross chargeable state? 333,000 minus son. How much? IHT is 3,200. So 329,800 is left to the son. 664. Still the same. This I hope you understood. Just deduct the IHT from 3,200 from this gross chargeable state and get what is for son. That's it. Now, summary of the death state. Valuation rules, quoted shares, unquoted shares, related property unit trust, land and buildings, life assurance policy. Make sure that you go through all this. I've covered all it. Okay. Then reliefs, reducing value, BPR and APR. And this are allowable for lifetime gifts as well. Okay, BPR and APR. You have to see the conditions. Allowable deductions, funeral expenses, outstanding debts, and other tax bills. Then exemptions, we have interspouse, charity, political party. They are exempt to residue. Transfer of residence to rate band and rate band. If deceased is a widow or widower, you can reduce the IST to 36 from 40 if you are leaving a substantial amount of legacy to charity. That is, you have to see the baseline amount. If your charity is more than 10% of the baseline amount, then only. Otherwise, it's 40. Reliefs, quick succession and double taxation relief. Quick succession, you have to look at the death of the 2% and within 5 years. Okay, so look for gifts to the deceased in the 5 years before death. Tax credit relief, that means from your tax you can reduce it. This is how you get your quick succession relief. I've given you the formula. IST on first death into percentage. IST on first death they give you, and sometimes through formula you can calculate. Given before DTR and DTR. DTR, you know, lower of the overseas tax offered and UK tax on. Then exempt residue. You have to see. This applies where the gift of the UK asset is left in the exempt residue. Like if it is left to spouse, charity or political party, then you have to do single grossing up. I've shown you. That is IST into 40 divided by 60. Next, the summary of the whole lecture. So first we started with lifetime gifts, specific valuation rules for quota shares and securities, quarter up, average, unquoted prices will be given, related property A divided by A plus C, then unit trust, the lower of the market margins, land and buildings, you have to see whether it's related, and life assurance policy, depending on the terms of the will. Reliefs available on lifetime and death gift, BPR and APR, very famous, the two. Give APR before BPR. APR on agricultural property value and BPR on the remainder if conditions are met. Then death state valuation rules. We went through allowable deductions, exemptions, residence nil rate ban, transfer of that nil rate ban and residence nil rate ban, and reduced rate if substantial charitable legacy, single grossing up. Reliefs, QSR and DTR. I have covered all. Thank you for watching, and I shall see you in the next lecture. That is also will be covering IHT. The remaining parts of IHT. So with this, I finish this lecture, and make sure that you do questions from your revision kit, from your past paper on single grossing up, exam legacy, residue legacy, all those things. You have to pick up and do questions. And do not forget to subscribe to my channel if you haven't subscribed, and make sure that you watch my previous lectures as well under the ATX playlist. All these lectures are relevant for your March 2025 exam. Thank you and take care.